We're looking at a sharp analysis of Micron stock, focused on its breakout past the $207 pivot, all driven by HBM chip demand, and these huge institutional targets going up to $325.
Yeah, really ambitious targets. And the piece does a good job laying out that contrast between the short-term technicals and, the long-term dream.
It does, but that's where I think we can dig in. While the analysis accurately highlights those massive price targets, the argument it needs to more fully bridge the logical gap between the immediate technical move and that long-term fundamental aspiration.
Right, it feels a bit like here's point A, the $207 breakout, and way over here is point Z, the $325 target.
Exactly. The weakness is that they're presented as two separate facts. The reader has to connect the dots on their own.
So the suggestion is to explicitly detail the path.
Precisely. We need to integrate those bullish long-term targets by identifying the required fundamental trajectory. That, it transforms the piece from just a summary of analysts' hopes into a real original projection based on things we can actually measure.
Okay, so give me an example. What would that look like?
Well, you could analyze the percentage of revenue Micron needs to get from HBM in, say, the next few quarters to stay on that path to $300 plus.
Or you could even look at the implied PE expansion needed for that $325 target. I mean, what specific metrics like gross margins have to improve to justify that kind of multiple?
Yes, that makes the whole thing feel much more grounded.
An ambitious path, but at least it's a defined one.
Right, and ambition needs guardrails. So, speaking of that, let's talk about the risk section. It flags the upcoming Q1 2026 earnings on December 17th.
Really clear technical lines. Failing to hold $200 could mean a retest of the 190 lows. That's solid charting.
It is, but I think the mention of the upcoming earnings report needs more depth to connect those fundamental expectations directly to the technical risks you just outlined.
Ah, I see. So it's identifying the event, but not the substance of the event that would trigger the technical breakdown.
Exactly. The weakness is the lack of specificity on what operational failure would actually cause such a precise drop. It's missing the why.
So we need to elevate it from just good chart reading to providing the fundamental color for those trigger points.
You got it. We need to strengthen the analytical depth by detailing the key metrics investors will be scrutinizing on that Q1 call, especially around the HBM ramp-up or traditional DRAM pricing.
So the technical levels, like $205 or $200, they become triggers for specific disappointments.
Yes.
So what's a concrete example of that kind of disappointment?
You could define a specific guidance range. For instance, what Q2 revenue or gross margin percentage would Wall Street see as bearish versus just acceptable?
Yeah. Or suggest an implied HBM revenue forecast needed to keep the bulls happy. That makes it crystal clear what level of disappointment would fundamentally justify a drop back toward $190.
And that elevates the entire analysis.
Okay, so to sum it up, the two main suggestions are, 1, really connect that immediate $207 breakout to the massive long-term HBM requirements. Use specific markers.
And 2, use the upcoming Q1 earnings to stress test all of that by linking those technical support levels directly to specific fundamental failure metrics.
These steps will make the argument not just technically sound, but fundamentally bulletproof.
We really encourage you to refine this work with these points in mind and send it back to us.
We look forward to seeing the update.